Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. Hey everybody, welcome to today's episode. We've got a very different kind of episode for you today. We're doing a legal, tax, and accounting panel with two leading firms. One is called Warren Averett and the other is Morris, Manning & Martin. And these are two leading advisory firms for founders that are thinking about exiting their businesses, and they provide support on the legal, tax, and accounting side just to make sure you have everything you need to have a successful exit at the highest possible valuation. I wanted to bring Hanny, David LeGrand, and Crowe on the podcast to bring their expertise in these areas to give advice to founders, because what I've found is when I meet founders, legal, tax, and financial areas are just things that are often ignored because founders are so focused on the day-to-day operations or driving sales and driving growth, and they kind of leave this area kind of out of their field of vision, even though it's so critical to building a successful company that eventually reaches an exit. So we put together this panel, and I went around the room and asked the right kind of questions, and you can see that they play really well off of each other because these two firms do a ton of work together as well. So there's some really great insight on this episode for founders, especially if you're thinking about getting to an exit. I want to make sure that you had enough resources to think about your exit and plan accordingly to have the right expertise in the room to give you the right guidance that's required in order to be able to get there. So with that said, let's jump right in and enjoy the episode. All right, everybody, welcome to today's episode. I'm super excited for our panel. It's a little bit unusual because normally we do one guest at a time, but the topic today is so interesting that we happen to get some really powerful and interesting guests together. So we have Hanny from Warren Averett, we have David LeGrand from Warren Averett as well, and we have Crowe from Morris, Manning & Martin. So guys, welcome to the show, and why don't we start by giving the audience just a brief background about yourselves and your respective firms.
Yeah, Shiv, thanks for having us and great to be here. As mentioned, my name is Crowe. I'm a partner in the corporate technology group at Morris, Manning & Martin. We're a full-service law firm based out of Atlanta, Georgia, mid-sized law firm, a little over 200 attorneys with the main practice being in Atlanta. We focus on representing companies in the technology space from startup all the way through exit, and then growth equity, private equity, and VC investors that invest in those tech companies.
All right, great. And Shiv, thanks for inviting us on this podcast as well. So I'm a partner within Warren Averett and lead our transaction advisory practice. Warren Averett is a regional firm, about 800 people, 15 offices across the Southeast. We've got clients across the country and in Canada, and of course, a few around the world. We focus very heavily on the technology space, as well as manufacturing, healthcare, and a few others as well. I lead our transaction advisory practice, where we focus on helping buyers and sellers get to a transaction. So we get involved very early, maybe a couple of years ahead of a transaction, all the way up to maybe the 90 or 120-day plan after a transaction as well. So basically anything that surrounds a transaction is where our TAS practice focuses.
Thanks, Hanny. I'm Dave LeGrand, tax partner with Warren Averett. I focus on merger and acquisitions, and then I also have a traditional tax practice. Shiv, really appreciate you having us on. Looking forward to the discussion.
Awesome. Thank you for that, guys. And so what's really interesting about this group is we met at Silicon Y'all, and that's headed up by Zane and the founders team. And really the topic of that conference is founders looking to exit their companies. And what I wanted to do by having you guys on is to talk about what founders need to think about as they are thinking about exiting their companies and what to look out for from a legal standpoint, from a tax standpoint, from a financial and accounting standpoint. And so I think that's a good place to start. And maybe we'll go to you, Zach. When a founder is thinking about exiting their business, what are some of the top things that you advise them to be prepared for or get in order?
Yeah, sure. Happy to walk through some of the most common ones that we see. And obviously every company is unique, and so work with your attorneys to get ready for a deal as Hanny mentioned, years in advance or at least a few months in advance to kind of get your house in order. That's what we always tell everybody is it's a lot easier to clean things up prior to a deal when you're not doing it under the gun of diligence with buyer's counsel who's there to force you to do it the way they want or to ding you on purchase price or to say we need another escrow or something like that. If you can work with your counsel to get ready for a deal and stage your house appropriately, it'll make everything a lot easier when you get there. And so in terms of that, a couple high level things just to make sure that you do when you're starting your process is set up a data room, right? You're going to need to have one when you do a deal. And so it's good to go ahead and have one that has your contracts all uploaded opposed to in a drawer somewhere, goes through and your counsel can take a look and say, this is what a standard request list would look like. If you don't have this, let's go ahead and put it in place, right? Let's make sure we have an IP assignment agreement from every employee. Let's make sure that employees are properly classified. And if not, that we're getting things signed on that phase. Let's make sure that you're not using open source licenses that you're not allowed to use or in the wrong way. And so by doing this, you can go ahead and get ahead of the process so that then when the buyer comes and starts looking, or if you're using an investment banker, they're ready to launch your data room, you're already ready here. And so that's my number one piece of advice in terms of when you're starting to get ready on the legal end.
And when you say get the data room in order, there's a bunch of different things that need to go in there, but you're specifically talking on the legal side. And what are some essential things beyond IP assignments that you look to advise founders to make sure that they have in place inside those data rooms?
Yeah, I flagged IP assignment just because that's so important to tech companies when IP is the material value driver. But the cap table and making sure that all of the related documents tick and tie on the capitalization is going to be very important. And so, if you need to go get people to sign and ratify stuff, you want to know that in advance. Having your key contracts in there with customers and making sure that those don't have any kind of right of first offer or most favored nations provision that's going to endanger the deal. Is another important one. And then on the non-legal front, you're going to need to have your financial statements in there, right? You're going to need to have employment documentation in there. And so it's really just kind of going through with either an investment banker or a counsel and saying, can you send us a typical list so that we see what this looks like and can go ahead and see what we can load? Because a lot of times it's what you don't have. That's the biggest issue.
That's great. And so transitioning to you, Hanny, on the financial side, I think that's a great segue. What are some critical things that you look for along with the statements to make sure are prepared inside the data room?
Yeah, and I'll just piggyback on what Zach was saying. We didn't even chat beforehand, but I was going to say get your financial house in order because there is a lot to do there. And to the point you guys were making, getting your financials in there is important, but making sure you're documenting everything that you need or that a buy side is going to be looking for just to get assurances that you're following processes and procedures. So oftentimes, folks don't document how they do what they do, and they're not consistent with their application. And that can be a deal killer, of course, as we come in, folks like ourselves come in, and Zach comes in and starts asking questions around this transaction, then that transaction, they're all being handled differently. And so, having some processes and procedures in place, I know it seems mundane and it maybe sits on a shelf for a little while, which we wouldn't recommend, but these are the things that you want to document and make sure your employees are following certain processes and being consistent, even if it may be consistently wrong. And I hate to say that in the wrong context, so we may need to come back to that. But consistency is key versus having all kinds of things happening. So the point that Zach was making about the cap table, we see all the time, where we come in and start to try to get the equity in order, of course, on the balance sheet. And we find that the cap table isn't being kept up with. And sure enough, as we get along, there's investor or two or three or four or five or 100 that start to come out of the woodwork. And it really does start to get very, very complex. And I think, Zach, you mentioned this just a second ago, but just belabor the point for a second. Verbal agreements are still, they can still be enforced. And I can't tell you the number of times we've been in transactions where it's a large transaction. And oh, by the way, that programmer comes out of nowhere and says, hey, you promised me half this business or whatever 10 years ago, and you're using my code and whatever. And so you really owe me $50 million of your $100 million deal, for instance. And so to me, I don't want to get off that point too quickly because I think that's a very important facet of something. So we'll come back to the VDR in a second. But Zach, I don't know if you want to, I'll pause there and just make sure you hit that point hard enough that our listeners are hearing this.
Yeah. That's certainly a good point there, and we've had that arise in deals, and you can watch your deal go away so fast when something like that comes up because buyers have no risk tolerance for there being capitalization issues. They're not going to pay you a bunch of money for your company and then have someone else come and sue them and say they actually owned a third of it instead. And so your best case is that you're going to have to agree to indemnify for that, meaning any losses the buyer has, you'll cover them. Your worst case is they say, look, we can't trust your capitalization reps. So as a result, we're not able to go get rep and warranty insurance, for example. And so we can no longer do the deal. And so if you find this out earlier, it's easy to go deal with this and say, hey, maybe we need to pay this person a bonus and get a release from them. Make sure that it's all buttoned up. Or maybe we got to go back and find that old handwritten agreement we had with them that said they don't own anything. It's all about, knocking these things out on your time and when you have the most leverage, because once they know a deal's pending, trust me, you don't have the leverage anymore.
Yeah, and we have tattooed on our foreheads, time kills deals. And then once you get into the deal world, you'll know this. And sometimes our clients on the sell side, at least, learn this the hard way. And I will say our buy side clients as well sometimes learn it the hard way because, you want to dot all your I's, cross all your T's. And, unfortunately, sometimes things, get out of hand and start to extend the timeline, which creates deal fatigue. And that creates, of course, a really harder chance to get to that closing that everybody's looking for. So back to the theme of the virtual data room, I guess I would bucket that into just getting organized. That was going to be like my number one theme. So I think Zach and I are tracking pretty well, is getting organized. And so knowing the terms of your arrangements, for instance, I can't tell you the number of tech companies that we come across that have, a variety of, customer contracts out there. And those customer contracts are tough to deal with when, you have 10 different versions floating around and each of them have different terms, concessions, discounts, whatever they may be. Those have a tremendous impact on revenue recognition, at least on the financial side. And when we're dealing with those kinds of things, I mean, your revenue, your ARR, your MRR, whatever it happens to be, could get thrown out of whack when you start to convert over to GAAP, which, let's pause on GAAP and we'll get to that in a second. But back to the theme of getting organized, I think, just knowing your terms of your arrangement. Zach mentioned having your employment agreements, having your cap table sorted out and reconciled, making sure all the agreements are memorialized, whether they're verbal, convert those over to written, trying to get all of these things organized. And then the only other thing I'll say is making sure you're tracking the data. You may not be on GAAP, and we'll talk about GAAP in a second, but tracking your data. I mean, that's important, knowing the lifetime value of your customers, knowing your ARR and MRR. I can't tell you the number of folks that quote these numbers, but they don't really reconcile back. So every time we get into diligence and we get going, we hear, here's the ARR, here's the valuation of this business, here's how we came up with that valuation. And we go to reconcile that number and that number doesn't tie. And we're having to figure out, well, why doesn't it? Well, this agreement was included, that one fell off. So churn becomes something very important to keep up with as well. And oftentimes folks don't know their number there. And so tracking the data to have all of these KPIs.
And just to jump in on that piece, how frequently do you find that founders don't have a tight grip on those KPIs and dashboards so that it's already in the data room before a deal cycle begins?
Yeah, I'll let the others throw their opinion and vote on this, but it happens more often than not, to use an accounting terminology. It happens very often.
Zach, has that been your experience as well?
Yeah, certainly so. We wish that it happened less often. And that's part of, having good service providers in advance of a deal and, going back to our original theme of getting your house in order. But yeah, it happens a lot. And we're trying to help reduce that over time. And I'm sure Ani is as well. But yeah, I agree.
Yeah, we've seen it on our front too, where companies don't have a full understanding of where revenue is coming from. And then they're not able to figure out how to invest more. And it likely affects valuations too, because if you don't have that information on hand, it's harder to tell a story about the future potential of a company, right?
Oh, no question. No question. I mean, that number changes even, a little bit. Your multiple may change if, assuming we can get into multiples if you want, Shiv, but I mean, your multiple may start changing if, that number drops below a certain size, that folks were expecting. Those investors are expecting a certain size business. They'll throw a size multiple on top of that if they need to pay a premium. As that ARR or MRR starts to fluctuate, valuation definitely changes. But I mean, I think trust and confidence in the deal is probably that much more important because, I mean, once one thing, the most important thing doesn't tie, what else have you told us that, we need to dig into? So certainly questions come up. Yeah,
Right.
absolutely.
And you mentioned gaps, so I think this is a good place to touch on this, and then I want to bring David into the conversation after you answer this. Is the ARR and the growth metrics and the churn, that's like one side of the data house, and then you have like your actual financial metrics and your revenue recognition and all of that needs to be in order, and then that also affects tax implications. So Hanny, maybe you can start with the gap side of things, and then David, I'd love for you to jump in there as well.
Yeah, no question. So generally accepted accounting principles is what we're talking about, United States GAAP. Most every investor, small or large deals alike. I mean, we work on a wide range of deal sizes. So really, you can't say the small deals don't really need this. The big ones do. Almost every deal we work on, the investors require the financials to be under US GAAP. And it's to create consistency, of course, so they can kind of value these businesses, based on what they've seen across the board. And so that US GAAP is what we're talking about. And it's really accrual based accounting, right? So getting away from tax based accounting, getting away from cash basis accounting, getting away from hybrids, because there's plenty of those out there, and truly focusing on what does GAAP, the standards, tell us to do, and then reporting your numbers based on that. And so the biggest thing for tech companies, there's three probably ones that I would bucket: revenue recognition, which we just talked about, knowing your performance obligations, creating a fair value for those, and recognizing them at the right time. And all too often, tech companies recognize revenue earlier than they should. And so the standards are written in a way to defer as much as possible, unless you're assured that you've basically earned the revenue that you're about to record. So oftentimes, tech companies will bill in advance, and of course they'll recognize all of that revenue during billing. And the standards would require you to defer that and recognize it over time or as you deliver the performance obligation. So we won't dig into that on this podcast. We certainly can, get into the standards when the time's right. So revenue recognition is one, and deferred revenue is a big component of that. So ARR becomes, a lot less if you start going under GAAP. Generally speaking, in a growth business, you have to assume that revenue is less under GAAP than it is under cash basis.
And the reason for that is that you may have an ARR run rate, excuse me, by the end of the year that's 10 million, but if you did it by GAAP, that future run rate isn't earned till the next December or whatever it is. So you're waiting on that revenue. So you might be closer to 8 million, for example.
That's right. That's right. And it doesn't mean the revenue is not there. I think that's an important point that sometimes investors and diligence teams get lost in. So I am going to say, hey, always kind of step back and think about, the mechanics and what the true essence of the deal is. I mean, it doesn't mean the revenue doesn't exist. And we won't get into diligence situations where the revenue truly doesn't exist. In this case, just talking about GAAP, it happens where your revenue is deferred and it's sitting on the balance sheet, but it'll come in, like you said, into the next year and it'll work its way up. So again, as a growth business, if you are truly growing, typically GAAP would show less revenue than more. And so you're expecting that revenue to start to make its way in. There is a reconciliation to get to MRR and ARR. You just have to kind of work that through. That's what we were talking about, earlier about getting to GAAP and then knowing your ARR and MRR and knowing how to get to that number. So that's one bucket of revenue, deferred revenue. The other one is capitalizing your software costs. So GAAP allows you, it actually requires you to capitalize those costs. And so all too often, our business owners don't know what those numbers are. So tracking those and following what GAAP says is going to be important. There's a lot of rules that we won't get into today, but definitely understanding the rules, at least on the surface, and tracking the data is what I mentioned before. That's what I would suggest today. And then stock-based compensation. So stock options, things like that we mentioned earlier. We really need to just make sure you're tracking all of that as well. So those are the three major GAAP items. There's plenty more, of course, but these are the three that we see all the time.
And on my end, you see this play through in the legal documentation of a purchase agreement when you're dealing with it as well, right? Because you're going to be making reps and warranties to your financial statements. And are you going to be able to say those are actually GAAP? Are they GAAP-ish? Are they completely something different to where we've got to work with your accountants to come up with a standard that the buyer can get comfortable with? Because all of these things flow through the financial definitions and the purchase agreement. So when you're setting a working capital target, right, when you're doing true ups for determining what's cash, what's debt, things like that, they're typically tied to GAAP definitions. So if you don't do GAAP accounting, there could be a disconnect there where you're not recognizing bonuses correctly or things like that. And it really, can slow things down in the deal. And as we talked about, time is the killer of all deals. Well, this could be one that can mess things up, especially if you don't have a strong CFO or accounting firm.
David, what are your thoughts on that from a tax perspective and companies not having this data organized? And then as they're getting the revenue rec, what are the tax implications of that?
Yeah, so when somebody comes to me and they're thinking about selling their company in 6, 12, 18 months, I usually ask 3 questions just to back up a little bit big picture. I say, number one, do you have an attorney that specializes in mergers and acquisitions? Not your high school buddy who dabbles on the side, but somebody who specializes in this because it is just so critical. I also ask if Hanny and his group can talk to them about EBITDA, ask them some questions about their financials to start getting ready in that sense. And then I also ask, have you engaged an investment banker? Are you looking to run a formal process? Kind of what's your timeline to try to get, the landscape of what they're thinking about and what they're trying to achieve. And then I guess specific from a tax perspective, when we're doing buy-side diligence, we keep seeing the same 4 or 5 things pop up pretty consistently, irrespective of deal size, whether it's a $2 million deal or a $250 million deal. We see these same 5 things pop up kind of over and over again, and I can get as specific into them as you want. But if you're an S corporation, which a lot of the targets in the deals that we work on are, is your S election bad? Do you have disproportionate distributions, more than one class of stock? Have you done some things with owners or other things that you may have done in the past that may violate your S election? Because that can completely change the paradigm and the entire tax landscape and how a business gets taxed when you sell it or when you buy it. So I think that's a really important point. Second, are you current with your sales and use taxes? Do you have all of that covered? Because there's 50 states and there's 50 sets of rules with respect to sales tax, and particularly in a SaaS context, they all treat it differently. And a lot of times, people aren't organized with that, and they've got a lot of exposure there. And we see a lot of deals set up big escrows or get retraded over sales tax issues. Third thing would probably be state income taxes, either from a physical nexus standpoint, meaning do you have payroll there? Do you have property there? Are you filing a tax return in all those states? And then from an economic presence standpoint, a lot of the states are moving to more of an economic test whereby if you just have sales there over a certain amount or a certain number of sales, they believe that they have a right to tax a piece of your federal income in that state as well. So we see a lot of exposure in the state income tax area with these nexus questions. That nexus is just a state's right to tax a piece of your federal income. So that's another area that we run into things a lot. Another thing that's 2 quick ones that are new is R&D expenses were typically deducted as you paid them. There's a new law that has kind of come into play effective last year in 22 forward, where you're required. Hanny had mentioned that you capitalize your software development expenses for GAAP. Starting in 22 for tax, you capitalize those R&D expenses 5 years domestic. And if you've got some offshore R&D development, we see this a lot. It's a 15-year amortization. So if you've got a couple $1 million of expenses there, you're supposed to capitalize those over potentially 15 years. So you get like 1/30th of it in the first year. This can kind of be a big timing difference for people, can provide some exposure. And so buyers can get a little concerned if you're not paying attention to that. Business interest is another area that has changed in 22. These are kind of some of the back-end revenue raisers on the Tax Cuts and Jobs Act from 2017. The last 5 years of that 10-year score, these couple of things have come into play, and they've caused some timing differences. They're reducing business interest. They changed the formula for that with respect to depreciation and amortization, which can be a big number for a lot of private equity and venture buyers. So that's another piece. The other thing we see is employee retention tax credits. This is a reasonably controversial area. There's some bad actors out there that are pushing these with a lot of our clients and other people out in the business community. So people may have some credits out there, may have gotten some money with respect to these payroll tax refunds that may not be good. And we're seeing a lot of people getting nervous about that, setting up a lot of escrows and retrading deals there. So those are probably the 5 biggest tax areas that we've run into the last couple of years.
How often are you coming into a situation where you kind of have to rebuild everything from scratch to make sure that all the T's are crossed off and all the I's are dotted just in the right order, just to make sure that the acquisition goes through? And then one of the things, Hanny, you said earlier is just that time kills deals, and you kind of are a little bit under the gun to do all this and at the same time do it in the right way. So how do you strike that balancing act?
Yeah, I think Zach's mentioned this earlier. I think it starts far sooner than a transaction, right? So, I mean, you may be considering doing a transaction in a year or two or three when you hit a certain metric or, accomplish a certain goal that you're trying to accomplish. So, you know, you should be hiring the right advisors at that moment. You should be thinking about the transaction at that moment so that, all your ducks are in a row, basically. And so do you get audits or reviews from our perspective? Zach, I'll let you kind of chime in here in a second, but do you get audits or reviews? Reviews are a nice step to get to an audit, but audits can add value to the business in a lot of different ways. And so at what point do you engage, an independent accounting firm to come in and do some of this assurance type work? Zach mentioned investment bankers before. It's never too early to talk to those guys. They're always willing to talk. There's a lot of plenty of good ones out there. And the idea is to just kind of have a conversation around here's what my business looks like. And, how should it look in the future? And then, we have, as I mentioned, we have services called value creation before a transaction is 2-3 years in advance. It's exit planning in a nutshell. There's plenty of folks that do this from the legal, financial, other sides, operational side even. And just talking to those folks about, okay, where are our weaknesses today? What is valuable to a buyer? How do we build this business so that it's very attractive and therefore yields the best result down the road? And so having these discussions early, I think that was going to be one of the points we discuss was, getting organized, get your VDR in order, and make sure you hire the right folks or find the right mentors at the right time. And so to answer your question, Shiv, I think it starts far sooner than most think. And so how often do we rebuild financials? I mean, it happens often. It's not, always disastrous as we're making it seem. I mean, there are situations where we'll find adjustments and things during what we're doing in diligence. And does it create a retrade situation? Maybe. It just all depends. But, we see it often enough that we have enough diligence adjustments that they will require people to think a little bit harder about the deal itself. And you never want that. So back to the point, let's just make sure we avoid all the unexpected issues. And the way you do that is proper planning. I mean, it just requires you to plan ahead.
Yeah, on my end, I agree with all that. The one that kind of rears its head the most in our deals, especially if they don't have a long-standing relationship with an accounting firm that is in this space, is sales and use tax. And so a lot of times we'll be dealing with someone that thinks, okay, well, I do have an accountant, so I've been GAAP-ish or close enough, and so I'm doing everything right. And then we're in a deal, and all of a sudden diligence gets into sales and use tax, and they don't know what that is, and their accountant is unsophisticated and doesn't know what that is, and then we're trying to scramble to bring in new accountants that are larger, that have more experience in that. And that's one of the worst ones that you can have to deal with, at the end on a deal, because you're going to have a buyer that's going to take a very, very conservative approach and try to ding you for the largest amount possible. Whereas if you had been remitting sales and use tax over the years or doing a VDA process to remediate and stuff, you could have ended up saving yourself a lot of money and a lot of time and effort there at the end. And so that's the one that's a real pain point on our end, probably just because I had it come up in a deal last month, but it's one we see a lot.
And we're in the middle of one right now. And I don't know, Dave, if you've seen this one, but I mean, our sales and use guys calculated $0 to $2 million of exposure, which is a massive range.
Right.
It's $1 billion fund that's trying to purchase an add-on. So basically a small deal that doesn't warrant a $2 million escrow for sure. But I mean, it can derail the deal, and we're in the middle of negotiating that right now. And the business owner, unfortunately, all too often doesn't understand that this issue doesn't go away with another buyer. It will always be there. And it's just something that, you weren't aware of before. Now, the diligence team has found this. The only answer is to escrow at best case scenario. Walking away from the deal isn't going to take away the exposure. So, how do you fix that situation when you as the seller were expecting to have a windfall of cash coming your way at the deal closing, and now you're not getting that same windfall, and maybe you have to wait a year or 2 or 3 for that money to hit your account. It's a tough pill to swallow.
Can you explain that process on the escrow side? Because yeah, there's what you get in the term sheet, and then terms can be adjusted and all that. But just for founders who don't understand like how something like that can affect their outcomes.
Yeah, I'll let Zach. Why don't you start with the legal side, and Dave, I'd love for
Yeah.
you to finish that off and talk about how tax actually impacts deals far more, not just sales and use tax, but the actual after-tax
And
proceeds.
planning ahead. Like I'm going to talk about a 5-year ahead situation
Yeah.
here in a minute.
All right, y'all go for it.
Yeah. So on the escrow piece of it, generally you're going to get a enterprise value that's going to say this is the high level money that we're paying you, and then it's going to be broken down into different components, and you're going to have more often than not an escrow or a holdback for indemnification coverage. Sometimes for other things, we'd like to minimize those as much as possible. Typically, a small one for working capital adjustment. But what we were talking about here with the sales and use tax is if a buyer identifies that there's exposure there for those kind of taxes or other taxes, there can be other things, right? A specific litigation, certain things they'll want to renegotiate and have another separate escrow. And what the escrow means is money, instead of getting paid to you and your shareholders at closing, gets stuck with an escrow agent and sits there for the time period in order to secure obligations that you may have. And so, for the sales tax example, any taxes that they identify within that period, which is typically going to be a couple years because they're looking back and they're going to take a couple years to go handle them, is going to get taken out of that escrow account by the buyer to pay those off. And only what's left will be reduced to you. Released to you, sorry. So if you have a $5 million sales tax escrow, they have to use $3.5 million of it to go pay taxes and penalties that are associated with them and their cost of their experts and things like that. You're only going to get 1.5 of that. So all of a sudden, your $100 million deal that you thought, oh, I'm going to get it all. Well, you didn't get all of it. And so the less that we can keep in escrow and the more that we can get paid to you at closing, the better, because it's tougher for them to come take it back than it is to not release it to you.
Yeah, on the sales tax, I've got one with an escrow that we're working through some voluntary disclosure agreements now to try to get that mitigated and try to get our guys as much of that escrow going to the sellers as we can. Got one of those going on right now. Happens more often than people realize on the sales tax. And then I guess just going back to the planning that Hanny had kind of touched on, just specifically one of the areas of the tax law that is really taxpayer friendly is it's called Section 1202, but a lot of people call it Qualified Small Business Stock, QSBS. If you're a domestic C corporation for tax, you can exclude 100% of your federal capital gain from taxation if you meet all the requirements for this. And it's really wonderful when it works, and it's really unpleasant when somebody thinks that they have that and they don't, because they did a redemption or they did something that disqualifies them from this particular area of the tax law. So one of the things with 1202 stock is you have to hold that stock for 5 years. So going back to the planning, you can go back 5 years before you think you might do a deal, and you want to be set up with that kind of structure so that your shareholders can hold that type of stock for 5 years to hopefully achieve that tax result. So you talk about a $100 million deal, the limitations like $10 million per shareholder per issuing corporation, and then if you've got it's the greater of that or 5 times your basis. So if you've got somebody who puts $5 million into a C corporation, they can exclude $50 million of gain. That's $10 million of tax at the federal level at long-term capital gains rate. So it can be a really material element of your deal that can really make things a lot more efficient, put a lot more cash in your pocket when you get done paying off your debt, paying all your fees, and paying your taxes. You want that final number, that final wire that you get to keep to the sellers to be as high as possible. And I think good tax planning can just be a huge piece of that.
And so how would founders go about structuring things the right way? Like if they are thinking about this, David, at least from your perspective, what would be the right steps to take to protect themselves as much as possible here?
Yeah, so I'd say just call us or your tax advisor and talk through the requirements of 1202 qualified small business stock. You want to have a domestic C corporation that's clean, that has original issued stock to your shareholders. There's 5 or 6 other requirements, but the biggest issue is domestic C corp, 5-year hold, the right type of industry can kick you out. Don't do any redemptions. This is a provision in the tax law that Congress intended to incentivize people to invest in small corporations. So I think there's a $50 million enterprise value, asset value requirement, but if you want to check all the boxes and be real careful about it, and what we like to do in that situation is we'll write a memo and walk through each of the requirements and how we believe your corporation likely meets that requirement, so that we can have that memo go out to the CFO or the board of the company that's selling, and they can get that memo out to the shareholders' individual CPAs, because the exclusion is actually taken at the individual shareholder level. So a lot of times we're not the CPA for the individual shareholder, so we like to have a memo. And a lot of times the lawyers will put that with a signature package and say, here's some of the tax ramifications that have been planned for you. Here's a memo you can put in your file, and here's a way to kind of document the position that we're taking here.
Yeah, and it's a big part of the way that we structure growth equity and venture capital financings as well, right? A lot of those have secondary components of it where the founders want to take some liquidity off the table, and there's ways that you can structure that to not be a disqualifying redemption if you're using counsel that kind of knows what they're doing in this space. The number of times that we've had clients come to us that we didn't start as their counsel, and they come and they ask about QSBS because they just heard about it. And then they say, oh, yeah, but the company bought out my co-founder last year and we paid him this amount of money. And we say, sorry, you're not going to be able to get it, or you just didn't think through and structure. It happens all the time. And so I agree with planning well ahead in advance of an exit for that, because it may be available and you didn't know it. And if it's the difference in selling, 6 months earlier versus waiting and you avoiding all of that taxable gain, it can be a deal changer.
Yeah, 1202 qualified small business stock can be really, really material.
Right. And from a founder's perspective, and just, I'm a small business owner, there's so many small businesses, even if you're a software company, let's say doing 10 million in ARR, relatively, it's not a massive company. There's a lot of work here, right? That can sometimes be taken by founders as distracting work, right? There's a cost to it. It takes time. There's a trade-off between doing this work versus other work. And at the same time, those founders don't have full-time CFOs, or maybe they have some sort of an accountant doing their basic bookkeeping and all of that. So taking on this work before you actually have a potential deal feels like a bit of a risk, because you're paying for the bankers, you're paying for the legal help, you're paying for the financial help. So just curious to hear your take on that piece, because founders are always trying to balance their cash flow and limited resources and trying to prioritize this when at the end of it, there might not be a deal at the end of it all anyways. So just want to hear what you think about that.
It's a tough question. I'll jump in first and let these guys simmer on it. But I've been a small business owner myself, and it like you said, you're wearing multiple hats. You've got limited resources, as you know, and you got to pick your battles. So, you got to prioritize best you can. Like you said, I mean, we're talking 2, 3, 4 years in advance of a transaction here. At that stage, it's so far in the distance. Like you said, maybe a deal isn't to be had. But the ideas here that we're promoting, at least beyond just the structuring, maybe QSBS falls outside of this, but the ideas we're promoting is more about planning ahead and increasing value in the business regardless, right? So GAAP accounting, for instance, doesn't really add a lot of value, right? You're looking at it and saying, well, I could get on GAAP, and what good does that do me today? I should be out beating the street, finding new customers, getting them in here. If you wait too long, it's going to be hard to reconstruct your books back to what people are expecting to see, right? So while you're right that maybe the time commitment doesn't quite provide the value you're looking for today, at some point it'll catch up to you and it may bite you. And that's what we're trying to avoid. And so you got to find enough time. So that's why I put it in terms of tracking the data and getting organized. You don't have to be on GAAP today as a great example, but getting to GAAP-ish, or having the data to rebuild GAAP when you need it. So knowing the terms of your arrangement as an example, knowing where your deferred revenue may fall out, having all of those terms in place so that, somebody like ourselves can come in and recalculate that quickly so it doesn't take forever. That's the key. So as a small business owner, for me, I would say you're right. You're completely right. Focus on the bread and butter of the business, build the business, but continue to sophisticate the business in little ways all along the way, and track that data. Make sure you know what you need. So that's why you need to talk to advisors, mentors, whoever. Know the data that you need and start tracking it and keep it organized. That doesn't require your entire day, doesn't require you to have a CFO or a controller, but at the right time, hire the right advisors, hire the right CFO, hire the right legal team, whoever it is. So I'll stop there and let Zach jump in.
Yeah, I mean, I think that's spot on, right? It's about balance. It's about doing what you can now with the time that you have and the resources that you have now, and making sure that you kind of talk to the right advisors for someone that's your size and the amount of time and resources that you have, right? It wouldn't make sense if you're a young startup company to go get a big four to do all of your accounting work, or the same on the legal perspective. You don't necessarily need the largest law firm in the world to help you out. You should work with people that are used to working with companies your size and what you're hoping to get to, that are willing to be flexible with you and know that you have finite resources and time and are used to working with startup companies, because those are the people that are going to tell you in honest advice. Here's what you need to do now. Here's what it would be nice if you could do eventually. And here's what's not really relevant to you. So don't waste your time and money on it. That's called being a good partner as a service provider. And, Tommy's point about choosing the right one, it can be worth its weight in gold for sure when you get to this exit and you realize, wait a second, this person just saved me millions of dollars, that I wouldn't have had.
Yeah, and on the tax side, I think like Hanny said, it's prioritizing. I mean, if I can take a look for a couple of days at some returns and ask some questions, maybe an hour phone call, that'd be about it. Try to get the landscape. Do you have a big nexus issue? Are you missing a bunch of states with sales and use tax? Is your S election bad? If we can kind of pick out the biggest two or three things, then over a couple of years you can work on that and not, chew up too much of your day. I think that can provide a nice return when you get ready to go to market.
It's just all too often business owners pinch pennies. It's fine, right? You're running with a short stack anyway, so you want to try to pinch the pennies, put it in the best place. But you get what you pay for, and sometimes you get what you don't pay for, and so you just have to be careful. So to Dave's point and Zach's, I mean, just not waiting so long and pinching so many pennies that you hired the wrong folks to do your tax return that didn't know anything about having to file in this state or that state or whatever. Maybe you had to pay an extra 100 or 500 or $1,000 that year and the next year and the next year. That comes in worth its weight in gold down the road, knowing that you've checked all the boxes you need. So that's the part about not pinching pennies so much that it actually hurts you in the end. But being frugal isn't a bad thing either.
Yeah, I think just in my experience, we've found a lot of success. We don't have a full-time CFO. We have part-time help. And I've found, just as a CEO, keeping on top of finances at a very simplified level, like our cash flow, what's our revenue projection, what's our EBITDA margin going to look like, how much are we going to owe in taxes every year, and remitting that regularly, making sure we're budgeting for all the activities in a good way. Whether or not the business is going to get acquired is almost less relevant. That foundational work helps you actually scale faster, because knowing how much cash you actually have on hand is like a superpower, because you know how much you have to invest in and what kind of targets you can kind of work towards. So I think all of that is really, really sound advice, and that's a good way to kind of end the episode. So with that said, if there are founders listening, how can they learn more about the work that you guys do and avail themselves of your services?
Yeah, on my end, I mean, you can visit our firm website. Morris, Manning and Martin is the name of the firm. Again, to reiterate, my email address, which I'm sure we can post with the podcast, is zcrowe@mmmlaw.com. We've got lots of free materials outlining a lot of these points that I've gone over that you could take a look at. So to the point about using resources effectively, they're free. And I'm always happy to chat. Kind of as Dave previewed, I'll go through with an hour for you and talk through things and just identify high level for you so that we can hopefully be your partner eventually.
Yeah, and we're no different. So warrenaverett.com, our website, has plenty. I think our transaction advisory page has probably a lot of these materials that we're talking about as well. And to Zach's point, I mean, our firms are very similar in this regard. We love taking these kinds of phone calls, no matter how small or large the businesses are. We work with all of them. Dave and I both, and I think Zach, you are as well, mentors to smaller companies, startups even. And so we're always happy to take these calls and just walk through things that people need to know. An hour, 2 or 3 never hurts. We're always happy to do so and give back to the community. So for us, we'd love for y'all to reach out. Let's just talk through whatever the issues are. If we don't have an answer or can't be helpful, we obviously will know some people that do. So that's the way we generally operate. So check out our website.
Awesome. So we'll be sure to include all of that in the show notes. And just from my side, I know you guys have worked on a ton of deals, sometimes together and with a bunch of common friends and other investors and companies that we know. So hopefully that testimonial goes a long way. And with that said, thank you guys for doing this. I thought it was a really interesting conversation. I actually wish we had more time, but I think at least it's a good starting point for people to come and learn more about what you guys do. So thank you.
Thanks for having us.
Thanks for having us. We appreciate it.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you enjoyed today's content and want more of it, please subscribe to the podcast on your favorite podcatcher. Number two, if you are in the market for marketing strategy consulting services, due diligence services, or fractional CMO services, please visit our website at www.howtosas.com and schedule a consult today. And number three, if you haven't already, grab a copy of my book, Post-Acquisition Marketing. It's available on Apple Books, on Amazon, and any bookstore that you can find online. Get a copy because it walks through the framework that we take all of our clients through, and it'll definitely add value to your business. And that's it for today. We'll see you guys next time.